Hey, good afternoon, good evening, you guys. Hervin here. I just wanted to shoot a quick video addressing what happened with the Silicon Valley Bank and its collapse and the other craziness that's really transpired over the last few days and what happened this morning and why the market opened so crazy. Just to give a bit of context here, this is a bit of a different video because I really was not intending to publish anything this week. I actually had my LASIK procedure done last Thursday. So as all of these things were transpiring, I had no screen access whatsoever because I wasn't supposed to be looking at anything. And in fact, this whole week my editors are off. The people that are helping me publish the videos are off and they're on vacation because I intended to spend a few days recovering. But this morning I got a call from one of my clients. It was actually a great conversation and it honestly made me feel very proud. He calls and asks about what's going on with the market. I was about to jump in and get into the to the talk somebody off the ledge mode because that happens frequently with financial advisors. A lot of our clients call us just asking reassurance. But as I was about to explain things to him and tell him that back in 2008, after all the banks collapsed and so on, a lot of people rushed to gold because it was a safe haven. And there's also people that should have just left their assets and left it invested. The people that just stayed invested outperformed the people that went to the safe haven. I was about to give him that whole spiel, but he just stopped me right dead on the tracks and said that, is today a better time to invest now? Should I pour more money in or should I wait until next week or 2 weeks from now? See, with this individual, we were already preparing to increase his savings and his contributions this year because that was part of the plan. We knew how much he needed to set aside on an annual basis from his corporation and his personal assets. But what I wanted to answer and speak to you guys about is just there's going to be a lot of uncertainty. Always. Doesn't matter what kind of market it is, whether it's a bull market or a bear market, there's going to be changes in the market. There's going to be changes in the values of stocks on a daily basis. So a 1% or 2% swing on any particular position on a daily basis is normal. But when I finally got to the point where it was time to answer this question, my response is pretty simple. 5 years from now, March 13, 2028. That day will come. And when you're at that point, you wouldn't remember, and it wouldn't matter to you whether you invested today or you invested 2 weeks from today. Assuming that we're following the plan and your investments are well diversified, look far enough in the future and you won't recall and you won't remember whether you were better off doing it today or waiting. So to abate some of his concerns, my solution was simple. Let's just figure out what you have as free investable dollars that you can deploy today. And for him, it was 50,000. So we decided that we're going to put in 25 tomorrow and 25 again in 2 weeks. The only reason we're doing that is to implement some regret aversion. To abate some of the potential regrets that he'll have as far as the timing is concerned. Grand scheme, not that important. So that's really the key takeaway before I go through all of this, is that if you already have a plan, if you're well diversified, there's nothing that you need to do right now. This is all just noise. However, because I had to update myself and I had to prepare and just in case other clients had the same question, I prepared some slides and I have them here. So this video will feel very different and I just want to answer some things here and give you guys a bit of a background. What I'll cover is just some context, and for you to make sense of this, you need to understand what fractional reserves are and what happens when there's a bank run and how human psychology and behavior actually makes that worse. And the interest rate hikes that we experienced in the last year, how this all ties into that. Of course, some takeaways, what to do and what not to do. So why is this whole thing significant? Well, SVB is the second biggest banking collapse in American history. So obviously it's a big deal. The other thing too that concerned a lot of people over the weekend was the FDIC took over on Friday, and they were willing to, clearly, because that's the rules, that's what's set up, that federal arm is there to insure depositors, that if there was a situation like this where a bank goes away, just says bye-bye, there's $250,000 that is covered. However, the Silicon Valley Bank is a bank for venture capitalists and startups and a lot of these tech companies. $250,000, tiny, when you put it in that context. So as it turns out, about 90% of the deposits were uninsured. There was a lot of potential ripple effects if this just happened and the government didn't step in. Imagine this, right? Like as a business owner, you have payroll to meet, you have expenses that you need to cover. You might have accounts receivable, cash that will come in and flow to cover any payables and so on. But if you have to pay payroll next week and your bank is closed and you can't withdraw, you can't access the cash that you have, it belongs to you, you're not going to meet payroll. You're not going to be able to pay your employees. And multiply that over however many companies are banking with the Silicon Valley Bank. So that was one of the big concerns, and it wasn't clearly accounted yet on who the depositors were, what the potential contagion would be. This is still all happening. They're in receivership. They're controlled now. There's going to be full audit, but today, Biden stepped out early and reassured the American public that their deposits are safe, that they can trust the banking system, that the government will be there to step in, intervene, and then the appropriate measures will be taken to investigate and to figure out what happened here and really make people that are responsible. One key thing that he seemed like he repeated a lot with his addresses was the taxpayers are not going to be on the hook here. That's how the FDIC works. The members actually pay into that in case that one of the other members goes under. They've already paid the premiums to get that insurance. However, where there was a lot of confusion was, how about the uninsured amounts? So this essentially becomes a bank bailout 2.0. I'll address that because I have other concerns with how the banking system will be affected if essentially the government says you can take unlimited risk now because we'll bail everybody out. That's another concern that I have. That's more fundamental than just this one bank collapsing. So we'll have another video about what the repercussions are with the banking system and the banking industry if this bailout continues and it becomes a constant habit, essentially, for the government to just take care of these institutions. So one of the things that made this so concerning for a lot of people was they didn't understand what happened. And one explanation that I have is just going back to the fractional reserves, the money creation or the money multiplier system that we have. When you deposit your money with a bank, let's take Joe here, for example. He puts 10 grand in the bank. The bank is expected to have that cash, right, when he needs to make a withdrawal or even some interest later on. Doesn't keep the money inside vaults, or they don't just keep it there labeled for Joe's withdrawal. We know that intuitively, right? What they do is they lend that money out to other users. In this case, Mary needs $9,000. They have to hold back 10%. So in this example, what I'm illustrating is a 10% reserve requirement. They hold the $1,000 in treasuries or other investable assets that they have access to in case there is a withdrawal. So looking at a bank's balance sheet, this is how that simple transaction would look. The assets the bank has is the loans that were given to Mary. That'll be an IOU. They're expected to get that back later, plus some interest, of course. Assuming that interest that they'll charge will be higher than what they're providing to Joe here as a benefit. And then they have $1,000 in reserves. Their total liability is the deposit that they should be able to give back to Joe when he needs to make that withdrawal. And then you do this again and again, multiplied enough times. What happens is the $10,000 initial deposit becomes $100,000 that's used in the economy. And it all works because not everybody makes the withdrawal all at once. But what happens if Joe now says, I want my money? The assets are there, right? The banks will be able to lend, just continue lending and provide funds to their depositors when they make withdrawals. But what if that same circumstance played out all over again? I want my withdrawal right now. Give us all our money now, with millions of Joes. Remember that they only keep a fraction. They only keep 10% of their deposits in the reserve in case that it needs to be accessed. Now, this gets even more severe, or it gets even more difficult when we are in a money tightening environment. Over the last year, let's call it that, the central banks have raised key interest rates to slow down the economy and to fight inflation. We all know that story at this point, right? This is Jerome Powell, if you don't know who's on screen. But here's one issue. There's a fundamental relationship with interest rates and the assets and the investments that the banks have to hold. As interest rates go up, the bond values or the fixed income instruments, the values of those deposits go down. That's typically not a problem when they can wait until the fixed income instruments, the bonds, the treasuries, when they can hold that until maturity. The cash just goes back and then they can redeploy. But it becomes a problem when this circumstance happens where, again, we're in that situation where everybody wants their money all at once. And I believe one of the key influencers on this was Peter Thiel, I believe, telling a lot of the companies that they backed to get their money out of SVB. Peter Thiel is a highly influential individual. So even a healthy bank, if you have a loud enough voice of fear and doubt, and it gets a lot of the depositors to doubt the bank's liquidity, that their funds are not going to be there tomorrow. Imagine everybody trying to get all their money out all at the same time. That can become a problem, especially when you're in a money tightening situation, where even if you had assets to liquidate, they're not worth the same as they were before, because the bonds you hold are not worth as much. Even the stocks, I don't know what the balance sheet is like for SVB. So what they did was they tried to raise capital last week, but they failed. They couldn't get enough capital to float the bank run. And in Friday, they went into receivership. The FDIC took over. All the executives were fired. And that's what happened. So what now? As I already mentioned, as of today, there's pretty much a full bailout for these institutions. So how does that impact the market? Like, what happened? I tried my best to delay this video as much as possible so that I'm getting screenshots of what happened with the market overall. The S&P At this time, almost at closing, down 0.29%. The NASDAQ was up 0.67%. The TSX, 0.81% negative. The Dow, were within a 1% variability at the end of the day. But because there was so much volatility happening earlier on, look at how wide the spreads are and how wide the swings are. That's actually what caused a lot of the halting in the regional banks. They were just down too much. They were just too volatile in the beginning of the day. But as you can see, overall, the market pretty much didn't react to it as much as I thought it would, right? So going back to how this applies to you. If you panicked early in the morning and that you sold, went to cash, and just forget about it, you could have realized significant losses, I suppose, depending on your position. But you put yourself in a whole lot of stress for nothing. We tend to forget that when we're looking at our investments, when we're accumulating for retirement, we are net buyers of assets. So the volatilities actually tend to help us. And even in retirement, there's significantly more things that we can control than what the market is doing. So you can control when you retire. You can control where you retire. You can control how much tax you pay and whether or not you realize a lot of the taxes up front or delay it and spread it out over your retirement. What account to withdraw from first? If you have registered assets, do you defer until you're hit by the required minimum distributions later on? Or do you realize them sooner to smooth out your taxable income throughout retirement? You can also do so many other things, right? Like you can look at your asset allocation, for example. So I have one last thing here that I wanted to show. And this is an educational tool that I just share with some of our clients. But you're seeing a 4% withdrawal rate here on the screen. I just want to tell you that I'm not a proponent of a stagnant, singular withdrawal rate. I'm not advocating for that. But this is a good tool for educating our clients. So let's say that somebody is retiring today and they're expecting to live for another 30 years. They have $1 million in savings and they're expecting to need about $40,000 annually from their investments. And they're going to adjust that with inflation. In this case, we're not going to leave a legacy capital. So they don't want anything left behind with their heirs, or that's already been taken care of. I don't know how that applies to you. You might wish that you're leaving a big chunk of this nest egg left over for your kids. But in this case, let's just leave it at zero. In a properly diversified portfolio, given this starting balance and looking at history since 1935, looking at 30 rolling years, there's 697 attempts, essentially. That's how I would simplify it. There's been 697 30-year rolling periods. You start your retirement today, plus 30 years, do that over and over again since 1935. We have enough data set to look at 697 different outcomes. Based on this portfolio, let me see what I even have here as an allocation. Again, not recommendation. I just wanted to share this as an educational tool. What is in here? 30% Canadian. This is geared too heavily to equity still. So let's adjust this. Five. And all right. Again, that's just for the sake of showing you that if you diversified, you'll be fairly okay. Not not giving any specific fund recommendations or anything like that. It's just we can use this to play around and show our clients what would happen if you decided, for this example, you decided to panic today and you just went into cash. Historically speaking, you took the odds of being able to meet your retirement and living for 30 years, meeting all your income requirement, from 100% to 27%, just by switching into cash and forgetting that there's other assets that you need to invest in. If you went strictly with fixed income, there's a 32% odds. I don't know about you, but if Air Canada or WestJet advertise that there's only a 32% chance that you're going to land safely in your destination, I'm not getting on that plane. And the whole purpose of showing that to you is that you can change how you invest and how you manage expectations, and you're making sure you're diversified. You can sustain a 30-year retirement with fairly good odds of success, especially if you manage your taxes well and you're understanding how you're withdrawing that. But if you panic, you could blow yourself up. So this video is running a little bit longer than I anticipated now. However, I do want to dive back into this and show you in a little bit more depth and a little bit more research what the concerns are that I have with the bailout. But as far as what you need to do, chances are it's nothing. But obviously, speak with your advisor, speak with your planner, and understand how your funds are currently invested, whether you're diversified enough, whether you have enough reserves to meet your liquidity needs. Understand all that. I just don't want you to be in a situation where you're panicking, freaking out, making permanent changes for a very, 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 very temporary situation, which is what happened with the market today. Let me know if this type of video is useful. I am not too comfortable with speaking off the cuff like this and not really having anything prepared and not having an editor go through everything. But I think that if this allows us to address current events more promptly and be able to help people not make stupid decisions, it's all for the greater good. So if this was valuable at all to you, please let me know in the comments. It really does help. Cheers.